Welcome to INVACT, your ultimate destination for demystifying the world of investments. Data released on Wednesday showed that a measure of America's underlying inflation surpassed expectations for the third month in a row, indicating that continued price pressure may delay the Fed's interest rate cut until later this year. The US recorded an annual seasonally adjusted CPI rate of 3.5% in March, higher than the expected level of 3.4%, the highest level since September 2023, while the monthly rate remained unchanged at 0.04%. The Federal Reserve is paying more attention to core inflation, excluding food and energy costs. The US core CPI increased 3.8% year-on-year in March, higher than the forecast of 3.7%, and remained flat. Core CPI increased 0.84% month-on-month in March, higher than expected 0.3%. It also remained flat at previous values, all exceeding expectations for the third month in a row. Looking at project segments, gasoline and housing expenses soared, contributing more than 50% of the increase. Auto insurance, medical care, and clothing expenses also rose, while the prices of new and used cars fell. After the data was released, spot gold plummeted by more than $20 in the short term. The US dollar index rose more than 50 points, and the non-US currency collectively fell. The euro fell more than 60 points against the US dollar in the short term. The pound fell by nearly 70 points against the US dollar, and the US dollar rose 70 points against the yen in the short term, rising above the 152 mark. The agency pointed out that US inflation has intensified and the price of gold has declined. It gave us a little insight into the thoughts of the bulls driving the price of gold to record highs. From the perspective of hot money, the rise in gold prices is not so much a hedge against inflation as a bet on lower interest rates and the weakening of the US dollar. Wednesday's report further proved that although the Federal Reserve kept interest rates at a 20-year high, progress in curbing inflation may be stalling. As a strong labor market continues to drive household demand, officials have insisted they would like to see more evidence that price pressure is continuing to cool before borrowing costs are lowered. The core CPI annualized growth rate for the past 3 months was 4.5%, the highest level since May last year. According to the U.S. Bureau of Labor Statistics, gasoline and housing expenses account for more than half of the CPI's month-on-month growth rate. The cost of car insurance, healthcare, and clothing increased this month, while prices for new and used cars fell. Housing prices rose 0.4% for the second month in a row, and the equivalent rent for landlords also rose 0.4% month-on-month. For some time, Fed policymakers have been expecting housing cost pressure to abate, thereby slowing core inflation. But that didn't happen. This has left the market questioning whether this will happen in the foreseeable future. This CPI report probably shatters the illusion that the inflation report for the last 2 months was an outlier. After data showed that inflation was higher than expected, bets that the Federal Reserve would cut interest rates in June have all but disappeared, and even the outlook for July seemed more unstable. Traders have also strengthened their expectations. Interest rates will only be cut twice this year, while the Federal Reserve's bitmap is expected to cut interest rates 3 times. The swap market shows that the possibility of the Fed cutting interest rates in June has declined, and the Fed's first rate cut has been postponed from September to November. Swap transactions show that the Fed will only cut interest rates by 50 basis points in 2024. Brian Jacobson, chief economist at Annex Wealth Management, said that the core inflation rate has remained at 0.4% per month, which is double what is needed to achieve the inflation target. The problem with inflation in the service sector is not just housing inflation. Rents, utilities, and labor costs for businesses all appear to have risen. Not only is the interest rate cut in June not on the agenda, it may not even be within the scope of discussions at the Federal Reserve. David Kelly, chief global strategist at JP Morgan Asset Management, also believes that the report shows that the door for the Federal Reserve to cut interest rates in June is already closed. Gregory Farinello, head of U.S. interest rate trading and strategy at Amerivet Securities, said, "The better-than-expected CPI confirms that the Federal Open Market Committee will take a more cautious approach to interest rate cuts. This also supports our short-term bearish view of the U.S. Treasury bond market as we work to overcome the hurdles on the path to 2% inflation." Thank you for watching. If you found value in this video, don't forget to hit the like button, subscribe to our channel, and share it with your friends and family. Together, let's embark on a journey towards financial enlightenment.